All righty. Hey, good to see everybody. I'm excited to have Jack Wang, and I'll give Jack Wang an opportunity to introduce himself. But also want to reintroduce Anna Liu on our team, who's one of our ops associates, marketing. She has her hand in everything, and she's amazing in everything. So excited to have Anna join us, and Anna will jump back in at the end. We are going to talk about financial aid. And actually, before we get into that, let me also remind everybody there is a, let me, oh, there it is. There's a Q&A box at the bottom, and feel free to ask questions at any time because I feel like there are a lot of questions that come up as we talk through some of what it means to obviously complete the FAFSA, CSS, to really present your financial world in an honest and advantageous way in order to make sure that families can afford college. And there's certainly a lot of questions and specific cases that are going on in your scenario. So go ahead and post those questions at any time in the Q&A box. Anna will come back at the very end and go through all the questions, and we'll give Jack an opportunity to answer those and try to be as helpful today as we possibly can. Now, I want to kind of set the table real quickly with regards to what we're doing tonight. Actually, real quickly, again, if you can help me with this as well, if you can go on to the chat and let me know where you are calling in from. So I'm always excited and encourage when we get families and students from all parts of the United States. So if you don't mind, go ahead and go on the chat. Just tell us where you are calling in from. Bay Area, San Francisco, of course, San Jose,
Can I add something
Fremont.
to that, Elton?
Yeah,
Yeah,
Texas.
as you're putting in your location, I mean, if you can always do it again, but I would love to know the grade level of your students, so ninth, 10th, 11th, 12th, or something else. So if you want to just pop it in, thank you.
All right, fantastic. So a lot of Bay Area, a little bit of Texas. Jack, you're from Texas, so I think this is going to be, like you'll have some affinity here. Las Vegas, a lot of Bay Area, San Jose, LA, fantastic. A lot of Californians, Santa Clara, absolutely. So Californians, some Texas, some Nevada, and go ahead and if you have an answer, go ahead and reply in. But want to set the table on our conversation tonight in that a lot of the families that we work with are certainly, they've come in and they've historically maybe don't qualify traditionally for financial aid, but college is so expensive. And it's still a challenge to really find the resources they need in order to make sure that, the tuition, the housing, the books, everything that goes into supporting a student all the way from year one until they graduate, making sure that students come out with as little debt, if no debt, as possible. And so, with average total costs for private schools inching close to 100K per year, there's no doubt that it is challenging for so many families, even for a lot of families, maybe dual income, especially in the Bay Area here, where there may be dual tech income, where the average household income is relatively high, but it's still super challenging to really afford college. So that's why I'm excited to have Jack in with us to really talk about how strategies, ideas, and ways for families who might share in that persona, that type of background, may be able to find ways to really navigate the college financial burden with greater success. So thank you, Jack, so much. Hey, we can get started off before we dive into like scenarios and situations. Why don't you would love to hear a little bit more about yourself, how you got started, and a little bit about your story about how you became a college financial advising expert.
Awesome, Elton. Thank you so much for having me on, and good evening, everyone. My name is Jack Wang. I'm actually in the Boston, Massachusetts area, so clear across the country from most of you. Although I was recently in Texas, I was actually in Houston for over a month. I was actually house sitting for my mother, and I myself went to the University of Texas at Austin, go Horns, and I was a finance major. I'm actually using some of what I went to college for. Not a lot, but some, definitely some. Um, so what I do today is I work with families all over the country on a couple of different aspects of this. One is how to maximize aid in order to lower the cost of college, which is different than what an admissions counselor or your son or daughter's guidance counselor at school, right? They're mostly responsible for helping your son or daughter get in, right? From admissions perspective, I focus more on the financial perspective on like what factors really drive aid, what do colleges actually look at, to lower the cost. And then the other major questions, what's the best way to pay for it, right? Is it savings? Is it loans? Is it something else or a combination of the above or whatever? And in my work with families, there are typically far, far more strategies and options and considerations than most people think about. Um, I originally got into this. So after college, I came to Massachusetts. I was actually going to be in commercial lending, so commercial banking. But what ultimately got me into this field is really for a personal need. Like I think a lot of people, especially those people who are self-employed, I think some, in many instances, it's because it's so I needed something for myself. So at the time, this was not after college. No, this was not immediately after, a while after college, but I was actually getting a divorce. I have two sons. They're 30 and 28 now. But at the time, they were middle school. And uh, in trying to reach the settlement with with their mother, my ex-wife, um, we had to put in something for a divorce provision, like who pays what and things like that. Because most divorce agreements are, parents will pay to the best of their ability, or parents to, for example, like what the cost of like a UC school for those of you in California, those of you in Texas would be like a UT&M, whatever, some sort of state school, right? Those are the most common type of scenarios. Uh, Coincidentally, at the time, I was actually playing in a men's baseball league, and one of my teammates was at that time a financial aid person for a internationally known college. And you probably all know the name because I won't say who it is, but it's commonly referred to by three letters, and it's located in Cambridge, Massachusetts. And so he was a financial aid officer there. So in between innings, I'm asking him, like, hey, how does this work? And how's that work? And stuff. Because I need to know for myself, right? I was trying to figure it out for myself. And so he was very generous with his time. And to this day, we are still friends. He still plays baseball. I do not anymore. Um, and and so I figured, well, if I need to know, other families probably need to know as well. So that's how I really got a start into this, was really trying to figure it out for myself. Over the years, I've been doing this for 15 or so years now, over 15 years. Over the years, I've worked with hundreds, I've talked to thousands of families. But today, I actually have a podcast called Smart College Buyer where I discuss these things. I actually just had Elton on as a guest to talk about passion projects as part of the admissions process. It was an awesome episode. Um, but you'll also find me speaking to various groups. I speak to a lot of professional groups, industry groups. I'm very active in the Financial Aid Association here in Massachusetts, which is the association for financial aid people who work at colleges. And actually, you'll see me in a lot of media. I do a lot of media quotes. So Wall Street Journal, Forbes, uh, CNN, CNBC, U.S. News. I don't know. Take your pick. There's a bunch of them. So you may have seen my name around with a lot of this stuff, or also regarding repayment of student loan strategies. So, but that's how I got into it. Was I was really doing it for myself at first, not with no intention originally of doing this for other people. It was just all for me in the beginning.
Got it, got it. And certainly like Jack, I mean, oftentimes what gets us started is really trying to figure it out for ourselves, right? And hopefully have figured it out for others, if you as you've figured out for yourself, you're giving yourself an opportunity to share that wisdom with others. So as we kind of dive in, I have certainly a list of questions I want to just tee up for you. But I think a common refrain that perhaps we hear from a lot of families, especially here in the Bay Area, is there's a lot of families who don't qualify for aid. But again, like paying full price for college in every respect is super difficult, and it should be. I mean, it's normal, and it makes sense. Like what can really be done? Now, it's a bit of a broad question to start us off with, but if you're perhaps too rich for aid and too poor for full price, like what, where do we get started for families that may have that similar sentiment?
This is such a common scenario, and I have a lot of families who are in this boat. Um, so I'll answer this in a couple different ways. And so let's sort of talk about the numbers first, right? Sort of, because actually what I'm gonna tell you later is that the numbers actually don't really mean that much. Much like in the mission side, like different schools have the different things they look at. There's no sort of one set formula. So with that, um, aid does not work by you pressing a magic button on the FAFSA or the financial aid form, right? There's no magic button. There's no like press this magic button and do three jumping jacks and your kid will go to college for free, right? That does not work. That's not how it works. So colleges, so the way it really starts with this, and really this is sort of laying the foundation as I get into the question. The way aid is determined by colleges is they take the sticker price. So that's tuition, mandatory fees, housing, food, books, transportation, miscellaneous. And as you said, Elton, right? Some of the colleges now are close to 100,000, or I know here in Massachusetts, there's a couple of colleges that are over $100,000 sticker. So everybody starts with that number. Okay, that's the sticker price or cost of attendance. From that, they then subtract how much they think you can afford per year. And this is really where, um, I'm not sure. Someone mentioned sound. Elton, can you still hear me?
I can hear you, Anna. Do you
Okay,
wanna
I
you
can.
wanna take a stab at that?
Oh, okay. I think we're
Yeah,
back. So,
we're back.
okay.
Go for it,
So,
Jack.
yeah.
Continue.
So I'm not sure what happened there. So you start with sticker price, then you subtract, then colleges subtract out what they think you can afford. So in the FAFSA world, that's known as SAI or Student Aid Index. It used to be known as EFC or Expected Family Contribution. And in the CSS world, and I'll talk a little bit more about those in just a moment, but in the CSS world, those are known as family contributions or just FCs. But SAI, FC, it's all the same. So they take the sticker price, they subtract out what they think you can afford. That bottom line number is called financial aid eligibility. Okay. Or your need or your financial need, if you will, as colleges refer to. If that bottom line number is positive, then you qualify for need-based aid, and most schools will give you a percentage of whatever that bottom line number is. Now, there are these schools um, that are what are called full need met, and what full need met means is that whatever that bottom line number is, as long as it's positive, they will give you that entire number in some form of aid, right? Grants, whatever. Um, but most schools are not full need met. They will give you a percentage of that bottom line number. And so what you pay for school, right? Again, this is not how much they think you can afford, but you actually pay for school in those circumstances is whatever they thought you could afford, right? That SAA number plus whatever portion of the need that was not covered. Okay. But a lot of families that are high income, especially families in the Bay Area, especially these sort of high cost of living centers, um, what they think you can afford is often higher than the sticker price. Um, and certainly higher than like what most people think, right? I've never had a situation where we've calculated this number and I've no family has ever said, "Wow, that college thinks we can afford way less than we're actually able to, right? We in reality we can afford way more, but they think we can afford very little money. This is great, right? That never happens. And so what happens is you take like a University of California school or Texas school, in-state public, that sticker price is probably like 35, 36, 37, but maybe the family, the school thinks the family can afford 50,000 a year or even $100,000 a year, right? So now you do that math, the sticker price minus this big afford number, and you end up with something negative at the bottom, in which case you're not eligible for need-based aid. Right. Okay. So people ask in that situation, well, Jack, I have all this money in my checking account. What if I go bury it in the backyard or hand it off to a neighbor for the day, or they can hand to you, Elton, for you to hold on to, right? Whatever the case may be. The reality is, for the vast majority of families, that barely moves the needle, if at all. In the financial aid formulas, income carries a far greater weight than assets. So if your family, let's say, has $500,000 income, right? Maybe that's a lot, whatever. But I'm just using an example. If you have a $500,000 income family and you have $100,000 in your checking account, burying that whole $100,000 in your backyard doesn't move the needle a lot because your income is so high, right? For burying assets, it would really need to be like your family income was, let's say, $100,000, but you had like a couple mil in your checking account. That makes a huge difference then because the assets really would outweigh the income. Again, I'm using hypotheticals here, right? So it doesn't have to be extremes, but I'm trying to give you some extreme examples to illustrate the point. Hmm. But if you don't qualify for need-based aid, all is not lost. Um, Number one, I actually tell people that families who do not qualify for need-based aid, you actually have far more financial flexibility than families who do qualify for need-based aid. Because after all, if you qualify for need-based aid, right, because your income's low or whatever, and you start working overtime or you get a big bonus at work or you cashed in some employer stock and had a big capital gain that raises your income, which can wipe out your own need eligibility. I've seen that a bunch where people have done something and killed their own chances for aid. Well, so if you qualify for need-based aid, you have to be very careful about those things in terms of how you manage your finances so you don't blow up your own chances. But if you don't qualify for need-based aid, then who cares, right? You can do whatever you want. It doesn't matter. So it actually gives you a lot of flexibility. We'll get into that more later. But also you can rely on merit scholarships, okay, which is not just about grades and test scores. There's far more factors to it at most schools. And you could be the poorest person in your neighborhood where you live, but I'm sorry, I said that backwards. You might be the richest person in your neighborhood where you live, but after filling out that financial aid form, you might still be the poorest family on campus. And so even though the numbers might not suggest you get need-based aid, the reality is wealthy families actually can get need-based aid. It comes down to other factors, even though the numbers suggest that you won't, right?
All right,
And
let
and
me.
so
Oh, go ahead.
so
No, finish. Yeah.
that's probably not something you've heard, those of you in the audience are probably not something you've ever heard before, but it's actually true.
So just to kind of jump in and make sure and summarize a little bit about where you've kind of taken us thus far. What you're saying is that the SAI or the estimated family contribution number is really based more on household income than it is based on assets. And so, in which case, if addressing income perhaps may have more of an impact on that actual student aid index than anything, right? And what you're saying is that like if you don't qualify for need-based aid, the sort of access to other types of aid may be more accessible. And you're talking about like specifically with merit aid, which I do think, we do maybe know a little bit more about. But certainly there are schools that are using merit aid to try to attract certain students to come. And they may use, some scholarship funding that may not be as accessible to everybody, but they're trying to target certain types of students to try to encourage them to really consider their university. So just to make sure I heard you correctly, did I get all that right?
Absolutely.
Hmm.
Real secret to aid, I think everybody, you look online and stuff, everybody's really hung up on the numbers. Well, the number says this, or the FAFSA says that, or whatever. And yes, those are important. You do need to know them. But the reality is the vast majority of aid for any given student comes from the colleges themselves,
Hmm.
right? It's their own money out of their endowment or whatever. So as a result, colleges get to set their own rules around that money, right? There's all sorts of examples around, like, why did a B student get a scholarship and not the A student? Right? Because sometimes the colleges might think, well, the B student came from a really wealthy family, they're likely to actually donate to the school. So we'll toss the kid, like the B student, like a little something to get that kid to the school. But the A student might be from, let's say, middle class family and unlikely donate in the future. And that kid might not get anything. As weird as that sounds, those things happen. Um, and so colleges have all these rules. So you might make $600,000 a year. You might make $1 million a year. That doesn't actually mean you're not going to get need-based or merit aid, because it's entirely up to the school in terms of how they want to dole out that aid.
Let's back up. I feel like you threw out a little bit of a little bit of a good nugget that we can kind of chew on, but maybe just to back up to based on income. I know we're getting some questions on income, and so as it relates to income, should families be trying to focus in on like reducing that? I mean, finding legitimate ways to reduce an income in order to qualify and be more accessible on their student aid index. So, for example, like say contributing more to your 401k, to other retirement accounts, to reduce that income. Like, what are like including retirement? What are some ways to reduce some of that income?
Yeah. So this also gets into school selection, because
Hmm.
different schools will use different formulas. And so while both formulas have the same underlying concepts, they look at income and they look at assets. both both formulas treat those figures a little bit differently in terms of what they count and don't count. So for example, like, you can lower your income by maximizing contributions to your workplace 401k, or even a
Hmm.
health savings account, or even a flex savings account. In other words, anything pre-tax, right? That's going to lower your income. And so on the FAFSA, your income is going to be lower. And the vast majority of schools in this country use the FAFSA, including all the UCs, the CSs, the vast majority of private schools around the country.
Hmm.
However, there are these other schools, Ivy League schools near Ivies. So in California, it'd be like your Stanford, your Santa Clara, your Pomona, Pitzer, Claremont, McKenna. In Texas, it'd be like Rice, TCU, SMU, things like that. And then you have, like Northwestern and MIT and Harvard and all that kind of stuff. Those schools also look at income, but what they do is those things that you do to reduce your income, like maximizing your 401k contributions or whatever, they add that stuff back to income. So from a financial aid perspective, you're really not reducing your income. And the thinking there is simply this: hey, you earned the money, but you chose to put it over there, right? Because you did. So for those schools, right, oftentimes I'll hear, like, hey, my take home pay went down because I maxed out my 401k contributions, but didn't move the needle on my CSS profile. Well, right, because all that kind of stuff is added back. The only other sort of legitimate way to lower income would really be through some kind of investments, especially like real estate investments, or business ownership or self-employments. There's some tax strategies there, taking depreciation and some other things. Even then, does different schools treat those kind of things differently? Um, Really, for most people who are working a regular W-2 job, you don't have that many, and you don't have, like, lots of rental apartments, that you're doing, or you don't own your own business or something like that. Um, for most of those people, it's really a matter of timing, versus, because there's not that many levers to pull to reduce your income. I'm sure none of you in the audience would want to go to your boss and say, "Hey, can you just please not pay me for next year?" right? Like most people don't do that. So, but you can do some stuff around timing, which is just kind of understanding when things hit the FAFSA and CSS versus not. Hmm.
Got it, got it. I actually want to go to, I don't want to go to questions yet, but I want to go to questions very soon. So why don't we tackle a couple other questions that I have here, and then we can go into questions. And I know that there's, probably a lot of them, as we get in there. But let's talk a little bit about like employer stock, right? So I think certainly, especially here in the Silicon Valley, you do have the W-2 employee that may have shares that are vesting or maybe fully vested, and it's a part of the assets. Where do shares come into play? And perhaps what if families might consider selling stock in order to help pay for college? Like, how do we navigate that whole aspect of employer stock?
Right. Yeah, so a pretty common situation, I'm sure, especially in the Bay Area, especially some of the clients I deal with who are from that part of the country. Um, you know, most of the time people who have employer stock or they just have large like investment portfolios, either way, right? College is coming up, they're thinking, well, I'm just gonna sell my stock if they can, right? If it's invested in stuff, I'm gonna sell my stock and pay for
Mhm.
college that way. And I have to say, like, there is nothing wrong with that specifically. Okay, if that's what you want to do, that's fine. But what I would argue is that there are some better, potentially better strategies. Um, so for example, um, you know, people, if you have a significant amount of stock, or if you're, let's say, a higher level executive, you might be able to borrow against that stock, much like we borrow against the equity in our houses, right? It's a secured loan. A mortgage or a home equity line of credit is a loan that's where the collateral is your house. Well, you can do that with stock or investment portfolios. Different firms have different policies around it, but you can do that. So that way you can access the money without necessarily having to sell, without necessarily incurring a tax bill or things like that, right? So that's actually a strategy that's actually used quite common by billionaires. They borrow against their assets, they borrow against their investments to buy their jets, go on vacation, or whatever the case may be. So that's one strategy. Another strategy is a little bit more tax related. And by the way, when you take it as a loan, loans are never income. So when you borrow against your stock to get that loan, that's not taxable income, so you don't pay income taxes on it. Another sort of tax related thing is if you sell the stock, you are going to probably incur capital gains taxes, right, of whatever percent. And depending on how much you sell, it could potentially even push you into the next higher tax bracket overall, so that you have income at even higher taxes, right? And so you don't necessarily have to do that. So another strategy is you could take the stock, and again, this is vested, especially if you're working for a publicly traded company, you can gift it to your student. That is allowed, right? Now you don't I'm I'm talking about gifting in kind. So I'm not talking about selling it and then gifting the cash, because as soon as you sell it, you would owe all the taxes and everything else, right? And we don't want that. But you can gift the stock, the shares in kind to your student. And chances are your student's probably at a 0% tax rate, right? And when they sell that stock with the gain, they're at a much lower tax rate than you are. Now, disclaimer, I'm skipping a ton of details. Okay, there are limitations and stuff. So I'm skipping a ton of details, right? Talk to your specific tax professional about the strategy. But I am talking about the idea, right? So the basic idea, what comes down to is, hey, if you want to sell this stock to pay for college, no problem. But do you want to sell it at a really high tax rate, or do you want to sell it at like a zero tax rate? Right? I vote for zero. Okay. So that's something. So especially people like concentrated positions, employer stock. Again, the natural inclination is, oh, just sell to pay for college. It's like, no, you don't. You don't actually have to, though. There are other options.
Got it, got it. So maybe just as a summary, I think what you're saying is that like if you do have employer stock, taking out a loan against those assets, potentially gifting it to your kids, as far as allowing them to be able to pay the college expenses might be a way. But what you're saying is that, well, what I hear you saying is that there are different ways to perhaps uh, deploy those assets in order to help pay for college expenses, other than just selling and then using the cash
Right.
to cover that.
Right.
Yeah.
One thing I'll just follow up on that point. You have to remember, and this is something that people often miss, is you have to remember that college is an after-tax expense, right? So whatever
Hmm.
you earn at work, right, from your job, you pay your taxes, and then what's left over, you buy groceries, pay for gas, pay your mortgage payment, save or pay for college. So a college that's $90,000 a year, again, obviously depending on the tax bracket, but that $90,000 a year college pre-tax could really be 120, $130,000, right? Which means you have to
Hmm.
earn like 130,000 to pay the tax to end up with the 90 that you pay the
Yeah.
college. And so sometimes when we talk about lowering cost, sometimes we can't get the tuition bill down. Like we didn't get aid from this college, and maybe your son or daughter didn't qualify for merit scholarship, but that doesn't mean we can't lower any cost because we can still work to reduce or even eliminate that tax drag
Hmm.
on taxes that you were going to pay anyway, right? So why not legally pay the IRS a little bit less money, and then you can use the savings to help pay for college, right?
Got it. Got
That's
it.
the
All
idea.
right. Absolutely. So let's talk a little bit about people who might be self-employed, business owners, and many business owners or self-employed people think that their options are the same as everybody else. And you kind of alluded to this earlier in our conversation. They might feel like they're the same as everyone else, but that likely isn't true. And what are some strategies that might be helpful for people who are business owners?
Yeah, so I often tell people the best way to save and pay for college, hands down, right? People are like, "Oh, 529 plan or whatever." No, the best way to save and pay for college, hands down, is to be self-employed or own a business, right? And people are looking at me like what? Like what? Because there's so many tax strategies available to you. So among the strategies, again, I'm skipping over a lot of details here, right? A lot of details. So first thing, let's just take, for example, contributing to a 401k workplace retirement plan. Well, if you're self-employed, you can open up your own 401k. You can contribute both as an employee and as an employer, typically up to 25% of whatever your net income is. But there are certain types of retirement plans, which are called defined benefit plans, that have a much higher limit. So now, obviously, you have to make this much money and meet some other qualifications. But for most employees, as an employee, you can contribute, I think like 24, I think it's like 24, 25, 27,000. Can never remember the number. Like each year you contribute like around 25,000 to your, employer 401k. As a self-employed person, you can do that into your own 401k and set up a what's called defined benefit plan. The limit on contributions before tax in a defined benefit plan is like $250,000, right? So if you make like 400,000, $500,000 per year, and you're self-employed, you could knock half or more of that off through these plans. And then especially if you then apply to a FAFSA school, they don't add those contributions back. Again, if you structure it properly. So now you really did you went from like $500,000 income to maybe like $200,000 in income or something, or even less, right? Depending. So that's one strategy. Another strategy is you can put your son or daughter to work. You can hire your son or daughter as employees to do bona fide work for a bona fide wage, where it becomes a legitimate business deduction to you as the business owner. You pay them, and the money you pay them, right, as long as it's below 16,500 per year, it's tax free from a federal level because they would fill out their tax returns saying, hey, they made 16,500. The standard deduction for a single person is 16,500. So I think it's 16,400 actually. So 16,400 minus 16,400 would be zero tax income or zero taxable income. So that income to them is tax free. It became a legitimate business tax expense to you. So you save on taxes on your end, your kid can turn around, just pay the college or even save it up. So that's another strategy.
By the way, that has
But
to be a legitimate, like your kids have to be doing something legitimate for your
yes,
business.
yes, you can. Yeah, yeah, it can't be
Just to
what's called like
clarify.
a, yeah, it can't be a no-show job. You
Yeah.
can't, and you can't pay your kid like $1,000 an hour to like do filing or sweep your office or something, right? Like it has to be legitimate pay for legitimate work. But
Mhm.
there's a lot of things that teenagers can do. So when you really sit down and think about some of your administrative tasks, your simple administrative tasks, whatever, or even like social media marketing, kids are really good at that. You
Mhm.
know, it's a great use for them, right? To provide legitimate work for the business while you pay them a legitimate wage. Um, Depending on the size of the organization and also the legal structure, you can actually get into what are called Section 127 plans. So you may be familiar with this, maybe not under that name, but if you work for a company that either has a tuition reimbursement or student loan repayment plan, those are Section 127 plans where like employer can pay for your college up to $55,250 per year tax free. It's right? It's a deduction on the employer end. That's a 127 plan. So there are a lot of these things in the tax code. So you can essentially start to use the IRS's money to help you pay for college. And I'm a
Mhm.
huge fan of that. So that's why I say like best way to save and pay for college, be self-employed or own a business.
Awesome, awesome. I have a bunch of questions, but I'm gonna bring Anna back on, and let's actually tackle some of the questions from the people who've joined us tonight, because I think it's best to try to be as helpful in their specific context as possible. So Anna, if we can go ahead and just dive into some of these questions and give Jack an opportunity to respond, that would be awesome.
Yeah, for sure. Just to start off, someone asks what options are available for students with, for example, H4 visa status.
If I so H4 visa status, I gotta remember that. I gotta think about that. So H4 visa. So here's the basic gist, the basic answer to that question. Um, International students, right, who are here on like a student visa or anything else, um, if they are here legally on a permanent basis, they are eligible for federal financial aid as well as institutional aid, which is money from the colleges. But if a student is here on a student visa or on a very temporary status, right, like a student visa, they are not eligible for federal aid, but they can still be eligible for institutional aid. Every school runs that differently because again, institutional aid is money from the colleges and they can set whatever rules they want. Now, I will tell you that most international students do not get aid because colleges, here's basically the way they think. Hey, if you're rich enough to send your kid over from whatever country, you probably have some money. And so most international students at most colleges are full pay students, and colleges love it because essentially they're the college's most profitable customers. But that does not mean that your international student won't get aid. It just depends on the school.
All right. We have a lot of questions about how colleges look at families' income. So when colleges look at families' income, are they sourcing that info of that income from a W-2 or from an AGI or adjusted gross income?
So on the the primary source is always going to be the tax return, and it is the prior year. So, for example, this coming fall, right, fall of 26, families of high school seniors are going to be filling out the financial aid form using the most recently completed tax return in the fall of 26, which means it is the tax return for 2025. So everybody starts there, but both formulas also have add backs, right? So, for example, on the FAFSA formula, there are, um, and also on the CSS formula, I should say, but even though the financial aid formula is based on the tax return, it does not follow the tax return directly. So, as an example, tax exempt interest, right? Like if you have a tax exempt mutual fund that that pays tax free interest, that might be tax free in the eyes of the IRS, but it is still income for financial aid purposes, both FAFSA and CSS. The CSS has more add backs. So the CSS adds back things like money paid by grandparent to pay for college. Any housing allowance, like if your job gave you a housing allowance or something, that's income. Disability benefits, if you collected either private disability insurance benefits or like an SSDI, even though it might be tax-free in the eyes of the IRS, it is still income for financial aid purposes. Um, so there's adjustments like that. It's primarily based off the tax return, but then each formula again adds back certain things, with the CSS adding back far more things.
And just to clarify, you were referring to like if you have a current rising senior who's going to be applying to college fall of 2026, they're looking at the 2025 tax return, correct?
Correct.
Mm,
Correct.
okay.
I did see a comment pull up about prior. So let me just explain what prior means. So again, if you have a rising senior, right, someone who's going to be a 12th grade this coming fall, they're a senior in fall of 2026, applying for financial aid using the 2025 tax return, but they're going to be going to college in the fall of
Mhm.
2027. So the prior term is the financial aid for 2027 is based on the prior year tax return, which is 2025. That's what
Gotcha.
prior means.
Hmm.
Someone would also like to clarify, just to make sure they understand correctly, that they can realize capital loss to reduce income. Is that correct?
You can realize capital losses. So for those of you who don't know, capital losses really stems from anytime you sell an investment, whether it's real estate, whether it's stocks and bonds or whatever, but you sell it at a loss. The rules are that capital losses can offset capital gains. So if you have $10,000 losses because you sold one thing and they had a $10,000 gain by selling something else, those two things can offset. And you can also go beyond the gain by $3,000. So in other words, if you had a $10,000 gain, you can have a $13,000 loss, right? So the $13,000 loss would offset the $10,000 gain and still give you another $3,000 loss. But you cannot go beyond that. So if you have losses that are beyond that, right, beyond the $3,000, those have to be what are called carried forward. So you can't, like, if you sold something for like $100,000 loss and no gains, you can't take the whole $100,000 loss in one year. You would have to carry it forward, subject to limitations. But yes, that is a way to um, lower gains. I will tell you in a practical aspect. Um, um, Most of the time, if I have to reposition assets, I'm using losses to offset gains, but I'm not really relying on the losses to move the income needle because again, you can only exceed it by $3,000 a year. It's usually not that much. It doesn't make a big difference.
All right. Some question about assets. Do stocks also factor into assets or investment properties? Do stock dividends factor into the income that's colleges take into account?
Yes, all the above, right? So really the assets are any investments that you own, whether it's stocks, bonds, mutual funds, or investment real estate. I want to be clear about this though. The intent does not matter. So I've run into a lot of situations where the parents, let's say, will own the grandparents' house, right? So you, as the parents, might own your parents' house, the grandparents' house, to help ease like estate transfers and stuff. So whenever I sit down with a family like that, they're like, "Well, do I have to report grandpa and grandma's house? We're not going to sell their house. We're not going to kick them out on the street, but we own, we the adult kids own their house." So the short answer is, yeah, you have to report that because you own it, right? I've had people say, "Oh, I have all this money in my savings account, but this money in savings account is going to be used for replacing the roof on my house, and we've signed the contract, we just haven't paid them yet. if we felt the FAFSA today, do we have to report it? Yes, you own it, right? Until it happens, if it's still in your hands, you got to report it. The exceptions to that, of course, are things like any assets inside retirement accounts, and those are retirement accounts by IRS definition. So 401k, 403b, IRA, Roth IRA. I'm very specific about that because people can and do save for retirement in a regular savings account at the bank that's not inside an IRA. So even though if you open up a savings account at the bank and you intend it for retirement, but it's not in the IRS recognized account type of an IRA, you have to report that even though your intention is for retirement. Okay. That came up recently, so I want to make that clear.
Great,
There
thank
are
you.
some
Oh, sorry.
exceptions and stuff to assets again in either formula, but if you own it, you have to report it.
Speaking of plans, we have some questions about a 529 plan. So how does that factor into eligibility? Are there pitfalls in oversaving for a 529 plan? Is it better to put money into that now or to keep money in a high interest savings plan?
So a 529 plan is a college savings plan. It's the advantages are that when you withdraw the money, the earnings on the money inside that account, if you withdraw it on a for what's called qualified educational expenses, so that'd be tuition, room and board, or housing and food, and certain other things, the money can come out tax free. So it is a really good way to, it's a really good vehicle to put money in to save for college. Whether it is right for your family or not really depends on your financial situation. I myself am not a huge fan of 529s, not because they're not good, they are good. It's that they can be very limiting because yeah, yes, there's some rules now we can roll it over into a Roth IRA and things like that, but it still takes time to get there. But most of the time when I work with families, what I find is money has to serve double or triple duty. What they could be a high income family, but they might not have enough saved for retirement. So if it's in the 529, it's kind of stuck for college. But let's say your kid gets a full ride scholarship somewhere because of Elton and Anna's help, right? That the money's kind of stuck in there. So I prefer having flexibility, and most of the families I see would really benefit from having it in an account that you can use it for almost anything, and there's no penalty. Financial aid treatment's basically the same. It's an asset. There is a difference there between the FAFSA and CSS, but if you open up a savings account to save for your student who's going to be the rising senior versus opening up a 529 to save for that same student, there's literally no difference from an asset standpoint.
But so there's some advantages to having a 529, but what you're saying is that there are some limitations to its use, and being able to
Yeah.
have some flexibility in your cash holdings may be just better for life, right? And that's what I
Right.
sense that you're saying. Okay.
I did see a quick comment pop up about, hey, if you can take money out of a 529 dollar for dollar if your kid gets a scholarship. That is true, but this is a nuance of tax law, right? I hear that a ton, and people say that. But you have to understand what the rule actually says is that you can take money out of a 529 for every dollar your kid got in scholarships. It's true, but you take it out penalty free, you can, but you are still subject to taxes on the earnings portion. Right. So now on the earnings portion, if that pushes you into next tax bracket or something else, you have to suffer the consequences for that, right? It is not, oh, my kid got $20,000 scholarship, so I can take $20,000 of money out of the 529 tax free. That's not true. There is still a portion subject, or maybe the whole thing subject to taxation. So that rule only allows for that withdrawal to be penalty free, not tax free.
Hmm.
We have a couple follow-ups to the 529 plan. One person asked, does the 529 plan in a parent's name, if the parent is planning on going back to school, affect the child's financial aid? And also, what about using the grandparent loophole in the 529?
So if the parent has a 529 their own name, so again, understand 529s. There's always two names on a 529. There is the legal owner, and then there's the beneficiary. Okay. The vast majority of time, the legal owner is the parent, and the beneficiary is the student. So in those cases, those 529 assets are reported as a parent asset. Okay. Now, in the CSS form, those are still reported as a parent asset, but you have to report all of the 529s you own. So if you have like 3 kids and you have 3 different 529 accounts, then you have to report all 3. If you have one that's where you're the beneficiary for yourself because you might go back to college as a parent, you got to report that too. You say you have to report all those on the 529 on the CSS. On the FAFSA, you only have to report the 529 where the student in question is the beneficiary. So if you have 3 kids with 3 529 accounts, but only one of them is the rising senior, you only report that one, right? So that is the difference there. Oh, and then the grandparent loophole. Again, difference in formula. So because if the grandparents are the legal owners, right? Again, it doesn't matter if your son or daughter is the beneficiary, but if the grandparents are legal owners, then that is not reported as an asset on either financial aid form because the ownership is outside of the immediate family. And when I say immediate family, that is the student's spouse, the student's children, the student's siblings, and the student's parents. Outside of that circle is outside the immediate family, whether they live with you or not. So if a grandparent owns a 529, it is outside the immediate family. So it's not reported as an asset. However, withdrawals from a grandparent-owned 529 can be reported as what's called untaxed income, even though it might be tax-free in the eyes of the IRS. So the FAFSA, untaxed income like that is not reported, so there's no impact. But on the CSS, withdrawals from grandparent-owned 529s is reported as income, and as specifically is reported as student income, which has a huge hit on the financial aid formula.
All right. Could you speak to federal loans, both plus and student, and alternatives to that as well?
Yeah, yeah. Okay. So the rules have just changed as a result of one big beautiful bill, which went into effect July 1 of this year. So for the student, okay, by virtue of filling out the FAFSA, your student is eligible to take out federal direct loans directly from the US government. It is loans to the student. There's no cosigner, there's no credit check, nothing. But how much they can borrow is very little. So freshman year, it's only 5,500. Sophomore year, 6,500. Junior year, 7,500. Senior year, again, 7,500 for an aggregate total of $27,000. That did not change with the law. What did change, however, is what you can do as a parent. The old rule was that you can use a federal Parent Plus loan, which was a loan from the government to you as the parent, okay, not to the student, it's to you. You're the one legally on the hook as the parent. But the rule used to be is you could borrow as much as you needed. So if your son or daughter went to that $100,000 a year school and you need to borrow $100,000, even if you didn't have a job, you could do it. That's no longer true. The limit now in the federal Parent Plus loan is $20,000 per year, $65,000 aggregate limit per student, which means if you borrow the $20,000 a year, you are done after 3 years, right? 20 times 3 is 60, throw in a little accrued interest, there's your 65. Any additional borrowing that you may need to do to pay for college, right? So anything above and beyond those is going to be on a private loan, and you as the parent is going to be involved, right, as a cosigner or as the borrower. And I emphasize that because so often I hear, well, if my son or daughter goes to a more expensive school, they're going to have to be the ones to borrow the money. They cannot borrow the money. Period. Full stop. If you need to borrow beyond those limits, it is on you, the parent, which means your credit score matters, your debt to income matters, and all that kind of stuff. Now, for graduate school, the changes were pretty major as well. The rule used to be the students themselves could borrow as much as they needed for any kind of graduate school, right? MBA, vet, dental, law, whatever. Those are the stories of I graduate college at $400,000. That's where that comes from. The rule now is for most graduate programs, students are limited to $20,500 per year with a $100,000 lifetime limit. And for professional programs being medical, dental, vet, law, nursing, OT, PT, chiropractic, optometry, nursing, there's a couple others. Those are capped at $50,000 a year with a $200,000 aggregate limit, which means if your son or daughter is planning on going to medical school, let's say, right, and they need to borrow like beyond those limits I just mentioned, that's going to come back on you as a parent, co-signing or whatever, right? Because they will have no ability to borrow beyond that. That's a far, far cry from what it used to be. Because what I used to hear was, oh, I will help my son or daughter with undergrad, but they're on their own for graduate. That's not true anymore because the rules don't allow that to be true anymore.
So even on a grad school student who's applying for a loan, even then they could be well above an undergraduate age. It would still be very reliant on the cosigner. The cosigner needs, and in most cases it would be a parent, but essentially whoever the cosigner is, it's going to be like they're going to be, their credit rating and everything, their financial world is going to be attached to that loan.
Oh, 100%, 100%,
Mm,
100%.
okay.
Yeah, and remember, as a cosigner, you are legally responsible for that loan, right? Like I've had
Hmm.
a number of otherwise highly intelligent adults say, "Oh, I'll just co-sign, but I don't need to pay. It's my kid's loan." It's like, no, no. If your kids doesn't pay their loan, the bank's coming after you, and those loans do show on your credit report. So it's not just co-sign. You are legally responsible for those loans, just like your kid would be as well.
Got it. We have a couple more minutes to address a couple more questions. Anna, what do we got?
I do want to touch upon a pretty specific question just because I think it really speaks to the varied and unexpected nature of families' college financial situations. Someone says that their spouse was laid off this year in March of 2026 and their kid is a rising senior. Is there anything that they can do to exhibit financial need for 2027?
Hmm.
Yes, they can. So if they're a rising senior, right, fall of 26, it's going to be used in 25 tax return, like we talked about earlier. And I'm assuming probably that in this instance, that parent had a job in 2025, so their income shows, whatever the number is. But obviously, that person isn't working anymore. So you would fill out the financial aid forms as normal, but then you would immediately appeal to the school and say, hey, listen, I know I submitted my 2025 tax return, but those numbers are not correct anymore. I don't have a job, my income's down, right? Please reevaluate based on my new income. Now, obviously, schools need documentation on this, right? So, there has to be like a layoff letter or something, or some documentation showing that you actually lost your job and you're not just making it up. Um, right? And you can document the income change. And so most schools will work with you. Um, Keep in mind, however, that so I think the question was that they lost their job in March of 26. Any kind of appeals for changes in circumstances, like lost job or whatever, I get this question a lot. Like if you, like for example, if you were told that you're going to lose your job next month and you're trying to appeal for more aid right now, they will not give it to you because that event has not happened yet. And obviously, companies or whatever can change their mind, or you might be able to get a job like the very next day after you get laid off from your company now, right? So any type of change in circumstance appeal, it has to have already happened. That's number one. Number two, it has to actually create some sort of hardship. I'll give you an example. I had a family out in California. The father got laid off a couple of years ago. Oh, he's making like 400 or 500 a year or something like that, something like that. So his income went to zero, and his wife was a stay-at-home mom. But he ended up taking money out from his retirement accounts. He took like $500,000 out per year from his retirement accounts to still live on while he didn't have a job. So his question to me was, why didn't the school give me any aid? Because I don't have a job. It's like, well, you don't, but your income is still there, just from a different source, right? So, like, in I don't know the person asking this question, like, okay, you might have lost your job earlier this year, but now if you're collecting unemployment and you're pulling money out of your retirement accounts, on paper, there was no hardship because your income dollar amount might look the same. It's just coming from a different place. Right. So the fact that you lost your job would be utterly irrelevant in that point. So that's why I tell this guy was pulling out 500 grand a year from his retirement accounts. I'm like, yeah, if he wasn't working, but on paper, he still had the income. So of course that school wasn't going to give him any aid, right? He still had the money. So
We had a couple of quick ones, Anna. So maybe we can do fire through the last couple ones and then see if get some quick response from Jack.
For sure. Should every student always complete a FAFSA just in case?
I had the great privilege of discussing this exact question with somebody on this call last week when he was in Boston. Um, so from a financial perspective, my answer would always be yes, although Elton might tell you no in an admissions perspective, depending on what your goal really is. The reason I say yes is because I always like to have students get access to federal loans. It's their way to have a little bit of a stake in the game. But I also know traveling around the country and talking to different schools that there are schools out there, well-known schools, where you do not even get a merit scholarship if you don't fill out a financial aid form, because if you don't fill out a financial aid form, what you're telling them is that you don't need the money. But can it minorly impact your odds of getting in? Maybe, right? So, if you're truly focused on, like, I want the maximum chance of my kid getting in, then you probably don't. But if money actually matters, then I think you should.
And
No,
then,
no
oh,
addendum to
sorry.
Jack's question. No addendum to Jack's answer on that one. Good job. Sorry, go ahead, Anna.
No worries. Does FAFSA consider debt to income ratios or mainly income differences with CSS?
So debt is not considered at all on the FAFSA, other than from an asset value. So, for example, like if you own a $3 million apartment building, you have $3 million of mortgage on it, then the net value be zero. That's the only time like really debt would be considered. Um, so if that's not considered, then debt to income ratio is not considered. On the CSS profile, the debt balance is not considered. But if you make payments on your own student loans, if you have them, then those payments are considered. But like whether you owe $1 million or $10,000 of balance, that doesn't matter. It's just the fact that like you had a whatever payment, right? It has to be on student loans. It can't be on other types of loans. Like it can't be like, oh, I had like $100,000 of credit card debt, I had all these payments. Like that doesn't count. Only student loan debt counts in that case.
Gotcha, gotcha. Hey, Jack, thank you so much. Hey, as we kind of close out, Jack, if you don't mind, go ahead and feel free to put your website into the chat so that everyone can go ahead and take a look. But Jack, so much appreciate your time coming on. I know it's been we probably didn't cover every micro detail that families may have questions about, but they can certainly reach out to you if so. And but appreciate just 1 hour of hyper impacted college financial aid talk. And thank you so much for your help and appreciate it. Again, for everyone who's coming on, we will send out the video likely to all those who attended. And we have some more webinars coming up in the coming month, but appreciate everyone's time. Thank you for joining us, and we'll see you on the next one. Take care,
Thank
everybody.
you,
Thank you.
everyone.
Thank you,
All right.
everyone.